Well, we did certainly see worries about Iraq seem to ease a little in terms of market list of concerns overnight. Still, of course, a focus though, but in the end, gains of 0.2% for the Dow and the S&P 500, NASDAQ up 0.33%. Of course, the Fed has begun its two-day policy meeting. We'll get the outcome tomorrow. And joining us now for more on what to expect, Larry Shover, Chief Investment Officer at SFG Alternatives, live from the CME Group there in Chicago. Larry, always good to see you. Thanks for your time. Just firstly on the Fed, the expectations, $10 billion tapering pace, rate rise mid-2015 seems to be the consensus expectation, but you say you need to be wary of that.
Yeah, I am worried. I mean, I'm not worried about that taper. I mean, even if they announce 15 billion as opposed to 10, I don't think that's going to crack the market. What I'm more concerned with is actually any kind of change at the margin, any type of speech with regards to the forecast, data, connecting to data points, tone of voice, that sort of thing. I mean, I'm not expecting anything huge, but any change at the margin could really disrupt the market we're in right now.
Because it's interesting, isn't it? This is a news conference meeting, isn't it? We get Janet Yellen speaking to the media afterwards. You know, last time she did front the media, of course, we did get the 6 months comment, didn't we? So something left field. I mean, it could come out of that news conference.
It could very well. And on top of that, not just a press conference, I mean, an updated economic forecast. And after our CPI number today, I'm just going to make it a little tricky. And then she's got to just promote the whole dots or connecting the dots for the next meeting. You know, but when you look at it, when you look at implied volatilities around the asset classes, it doesn't seem traders are willing to accept that there's a big risk of anything big happening tomorrow. Perhaps the Jackson Hole speech would hear something, but right now it just doesn't seem very likely.
In terms of the data that we've been getting, I mean, the inflation print really seemed to buoy equity markets overnight, coming in better than expected there, and fastest pace of growth in around a year. I mean, that though, at the same time, we've got some disappointing housing data. So how do you marry it all together?
Yeah, it's a good question. I think it's because we're just in this economic status quo, and the market recognizes the fact that the numbers in China are stable. I mean, they're growing. We have GDP forecasts around the world that, yes, they were lowered a little bit last week. However, they're right down to where consensus thinks they are, and that we're coming up to corporate earnings season, and it seems consensus believes that it's going to be better than expected, or the risks are going to be to the upside. You combine that with you know, poor housing permits and housing starts and CPI number, I think it just one or two numbers isn't going to crack the market.
So just on Iraq, so just wanted to get your view on how much of a concern it could be for markets. You know, if they're looking for an excuse to correct it all. It seemed to ease off overnight, but obviously it's still a major concern.
Yeah, you know, actually, what nobody's talking about is this division that we're seeing right now. It seems like the way that the stock market views the Fed and the evolving monetary policy are two different tracks right now. And there seems, in America, we call that, we need to have like a fence-mending party at some point where the stock market has to recognize where policy, inflation, and growth is right now. But it seems that the stock market is almost drunk with being dovish, almost to the point of being irrational. So with that in mind, we've had a 3.5% up move since May, almost in a straight line. It wouldn't take much to disrupt the markets. And so right now it's all position and sentiment, and that seems to be a little bit neutral and negative right now.
Just in terms of the currency moves as well, how are you playing that? Because we did see some dollar strength after that inflation data.
Yeah, and I hope to continue to see that. I still think being long the U.S. dollar versus the euro is a good long-term trade. I have not adjusted my my trade bias on that. I mean, I am thinking by the end of the year we could easily see 130 in the euro-U.S. cross. And I know it's been very, very stubborn, but I do believe when you look at the balance sheet of the ECB compared to the Fed, it's almost a no-brainer that it's going to trickle lower and continue to do that the rest of the year.
What else are you doing at the moment in terms of strategy, given what we've been seeing from the ECB and the Bank of Japan as well?
Well, you know, we're more of a momentum fund, so we don't have any really long-term positions, but we do have a bias to be long yield right now around the world, seeing that we seem to be healing. We are short gold, and I say this all the time. I mean, as an investor, I don't think I'd be short it, but as a trader, I would be. And when it comes to oil, I'd like to continue to be short Brent, even up here 106 area. I do believe that the whole thing that's going on in the Middle East may be a little bit overstated, and I think also they might be overstating some of the demand issues that they've had.
All right, Larry, it's always great to get your views. Thank you so much.
You're welcome.
Larry Shover there from SFG Alternatives from the CME Group in Chicago. We are going to take a very quick break here on First Business. Coming up, we're going to get some more analysis, some opening calls too for the market today. Mark Todd joining us from the NAB in just a moment.